All right, joining us right here on ET Now is India's Secretary in the Department of Economic Affairs and someone who keeps a very keen eye on what happens in the world around us, Indian markets, and of course everything else that has to do with the Indian economy. It is indeed my pleasure to be welcoming Mr. Garg right here on ET Now to take stock on the state of the Indian economy. Mr. Subhash Garg, thank you very much, sir, for being with us. I will obviously first begin to talk to you about what US President Donald Trump is doing.
Thank you.
He has announced, Donald Trump announces a 25% tariff on 50 billion worth of Chinese imports. This step will obviously have repercussions from China as well. I'm sure some retaliatory moves. It really marks the shift of a verbal skirmish to what will perhaps be a full-blown trade war. Many people believe this will impact global trade. Can India just cite its strong fundamentals and insist that it will stay insulated?
See, the implications of what American president has done with respect to China and certain specific goods will need to be analyzed in terms of what those products are and where do we have any implications for our items for trade and all. But otherwise, you saw the data for the year and the fourth quarter release yesterday about India's exports and balance of payments, and also the May data which the Commerce Ministry released today. Our performance has been reasonably and in fact quite strong, with exports having gone up by 20%. This is one of the highest rates for quite some time. And despite the oil prices having risen substantially, May imports were only about 15% higher. So some of you are playing up as if the trade deficit has gone up sharply. It has gone hardly by any measure. The real bigger news was, I understand, in my judgment, that the exports grew by 20%, and despite the oil prices, which had the implications about $5–6 billion, our trade deficit was only about $700 or $800 million more. So as far as the implications of US action, I think we'll have to wait for some more time.
But sir, just a quick follow-up on that before I move across to CAD and the trade deficit. Do you fear that the United States could now follow its tough talk with India on trade with similar action as against China, given that they do run a trade deficit with us? Is the very nascent, and you're right that export growth has picked up, but is the very nascent growth now once again at risk on account of this?
Our trade surplus with the United States is hardly any bigger. They have a cutoff of $20 billion. That's why we just come in. We were very close to $20 billion in terms of surplus with US, but that's hardly in comparison to a couple of hundreds of $billion surplus with China and others. So I don't think that is, in Indian context, it's more to do with some specific commodities where there is a perception in the United States that the tariffs are higher. I think that's more to do with that rather than the bigger, though nominally the cutoff is what is attracted. And that plays into that monitoring list which also the US maintains. So I don't think we have serious implications, but much can be said only after studying in detail what kind of products he has imposed additional tariff.
Mr. Garg, let me just turn focus and talk about numbers that you alluded to a little while back, and that is the trade deficit. It is at a 4-month high of $14.62 billion. You're right, it hasn't gone up substantially in the month of May, but as imports surged nearly 15%, oil imports are up almost 50%, CAD has shot up from 0.6% to 1.9%. Now, most brokerages expect the current account deficit to touch levels of 2.5% to 2.7% in this financial year. There are obviously concerns as far as the twin deficits are concerned. Can the government do anything given that the crude prices have reversed the trend? Are there genuine fears on India's current account deficit?
Let me reassure, and that's my very considered assessment, 2 to 3% current account deficit for India is not at all a matter of worry. That's what is the way the world finances and transfers capital to India. So that kind of level should not be a worry at all. What might worry a bit is that do we have this going further beyond 3% or 2.5%. So that is something which we need to watch out, and it was in this context that when the oil prices were going beyond 80 or to that level, that was causing quite a deal of concern that in case that were to be the case, that how do we finance, because the supply of dollars and the demand of dollars, if there is a gap in that gap has to be met, and if that gap is not met, then the exchange rate tends to depreciate for us. That is what was the worry, but for the time being, for last 2 weeks to 3 weeks at least, one has seen the oil prices declining and also stabilizing, and the futures and other things are also telling us that the likelihood of oil going beyond 75%, $75 and averaging at that is much less now, and that is quite a comforting thing to us. I think we have enough, not only the capital account transfers which should take care of the CAD of the level of 2% or 2.5%, and the portfolio investors might also soon return. So at this moment, while it's a cause of concern, it's a matter to be watched, and one need to take one should keep very strong watch on that, and if need be, then adequate measures would be taken for that.
Mr. Garg, you're right in saying that oil has receded, and perhaps that's giving you less sleepless nights than when it was inching up higher. But the era of easy money is clearly fading away. The European Central Bank is set to end the bond buying program by December this year. Add to that the fact that the Federal Reserve is now looking at 2 more hikes in this entire year. I know you will say that India has strong macros, but do you also believe that FII outflows along with some other macro headwinds, yes, oil may not continue to rise at the level at which it was, but it has not receded to levels. I mean, oil has appreciated about 32 odd percent as far as the present period between last year and now is concerned. Does that make the fiscal marks tougher to reach? 3.3%, is that going to be increasingly challenging?
So the first implications of the quantitative easing or the easy money policy being reversed in America, in Europe also now is what normally people would expect, that the transfer of capital or flow of financial resources to emerging market countries would come down. That is the first sort of expectation which materializes. But I would point out to you that in the recent episode for last 3 or 4 years, and this easy money policy was started being followed somewhere around 2013-14. There's not been a very strong inflow of capital or financial resources from the advanced countries to developing countries. In the context of India also, you would have seen, while last year the foreign portfolio flows were about $20 billion plus, but the year before there was negative flows. So there has not been very much and very strong flows to India, and therefore when the policy reversal happens, which is started to happen now, I don't see very large outflow of the resources going from here. Most of the investors here are there for quite long term, and therefore that while with the interest rate going up there would definitely be some outflows, but it wouldn't be a torrent, it will not be a flood, it wouldn't be of that magnitude that we should be excessively worried about.
Right.
Now, the impact on fiscal side is something to that effect, that when there is lesser demand from FPIs for the government bonds and all,
right,
the yields tend to go up, and which has been seen in past some time. But we have had full subscription, yields have also stabilized.
Right.
Recent most rate hike you saw in the US,
right,
despite at that time the yields have not gone up to that level. So and it seems to have been priced in quite a lot. So there would be definitely some impact, but
right,
when we issue about 5 to 6 lakh crores of bond in a year,
right,
at 1% it matters about 5,000 crores even for the entire year. So that doesn't play out so quickly, and therefore we should be able to take it in our stride.
Mr. Garg, you were one of the very first few people who tweeted after the RBI policy action this time. But I'm going to take a larger question. The WPI has shown an uptick. The CPI for the month of May is at 4.87%, which is a 4-month high. Given oil prices are high, MSP still is in the works. You will have to deliver on that. In its monetary policy, while raising rates this time, the RBI very categorically stated that core inflation that excludes food and fuel is sticky, and it's at levels that is not comfortable for the RBI. Given this commentary, has the monetary cycle turned from here on? Are we in a monetary tightening regime?
See, food inflation is not at all at any levels where one should have any concern. In fact, it is lower to my mind. The farmers don't get that kind of prices if the food inflation is so low. The recent most contribution has come from the fuel. The wholesale price index data released yesterday said about 11.5% increase coming from the fuel, which alone would have contributed about 1.4% of the 4.4% increase in the WPI. So that is because of the oil prices and all. When these stabilize now, I think there should be some reduction or the lesser hike in the month of June when the data comes, with the reduction in petrol prices by about 2 rupees and diesel also. So that again, my judgment is that we perhaps even on the inflationary front, we are at a level which might and should depict the highest possible levels. RBI also in its own judgment said that in the second half the inflation would come down. So with that, if that is the trajectory of inflation in the range of about 5% or lower for the year, in fact lower to my mind, it's the call which the MPC takes.
Right.
But fundamental reasons going forward should be as severe or as demanding as it was the case last time. To my mind, that doesn't seem to be the case.
Okay, Mr. Garg, you earlier alluded to the fact that oil consistently has been coming down for the last 2 weeks. There was obviously mayhem when oil prices were going up consistently for 13, 14, 15 odd days. Now, given the fact that you've been able to pass hikes up until now, you've got some breathing room. Is it now a given? Is it perhaps easy for us to presume here that now, because oil is cooled off a bit, the whole special formula and the whole partial deregulation that was being spoken about is no longer priority, or will the government still look at partial deregulation to insulate consumers if prices were to go up?
No, my sense is that the system which is in place is good enough to continue for the situation in which we are. And we have examined various options which can be resorted to if the prices cross a certain comfort level. So I don't think it can be said forever that these those options and the long term solutions are off the table. They are not. And those would be discussed, and some urgency comes when the prices cross a certain threshold. At the current stage, that urgency is not there, but the search for the longer term solution continues.
Okay. No urgency, but the search continues. Let me quickly talk to you about the currency, sir. And the rupee has weakened by 5% against the dollar in 2018. People thought, especially when oil was on the rise, that there was more weakness that was expected. What's your view on the currency? Do you believe the much warranted correction has happened, and are you comfortable with the rupee levels at which they are right now?
My sense is that the current level represents the market's demand supply situation, and the Reserve Bank's policy of not allowing extreme volatility in the exchange rate is what is there, and therefore the current situation perhaps doesn't warrant much of the intervention, because there is no such volatility of that type visible. So let the market forces play its role.
There was a big bang sale of Air India that didn't quite incite investor interest, and you've been on record to say that Prime Minister Narendra Modi's administration is ready to re-examine its privatization process, including a clause that requires a minority stake in Air India. Is that what the government thinking is right now? Are you willing to dilute the 24% stake, because it is that stake, and on account of that stake, 2 nominee directors on Air India, that has scared away a lot of private sector participation? They don't want to be on board with the government also having a say on the table.
You see, I think it was ET which President possibly put a spin which I did not say. But let me say, the attempt with a certain kind of configuration and design did not succeed, and therefore it's very natural for the government to look at alternative designs, and because the commitment to privatize Air India continues unaffected, so that is there. Now, in the revised scheme of things, all the possible options would be discussed. No decision has been taken, no particular view has been taken as yet, but those various options are being considered, and at an appropriate time, the group of ministers which is tasked with this job of finding a new formula or a new structure for the proposed privatization offer in the roadmap, it will come up with that.
Okay, let me turn focus, sir, and the Interim Finance Minister, Mr. Piyush Goyal, has suggested a committee should look into the formation of a bad bank. Now, why is the idea of a bad bank back on the table? What has really changed now? Because this was an idea that was toyed with earlier, it didn't quite go through. Do we have the funds to back it? See,
the fact that there are bad assets, the non-performing assets are, this is a fact, right? And in the system, the level at which the non-performing assets are there is quite high and elevated. These assets need to be resolved. These assets need to be restructured, resolved, sold, and whatever. So there are ways to deal with it, but those have to be dealt with. Now, you have the options that you deal with it in the existing banks, or you think about a specialized bank or an ARC or any other appropriate organization where these assets can be resolved. There are certain arguments for a kind of concept which finance minister spoke about and constituted a committee. Today, for the same borrower, 15 PSUs have lent, all of them are trying to recover their one. It would be perhaps far more efficient if their loans are consolidated in one place and a more professionally tasked or oriented manager or organization takes care of those assets. So, it is from the efficiency point of view also, there is something to look at that kind of idea.
Okay.
So, what has happened is that this is being examined, and if it leads to that kind of conclusion that such a structure, such a system would be more efficient in resolving and getting the money back for the banking system.
Right.
I think that should be looked at with very open mind.
No, absolutely. There should be an open mind to any proposal on the table that could take care of India's NPAs. But sir, the RBI Feb 12th circular is in the eye of a storm. The Bank Association has moved a writ petition in the Delhi High Court. Power sector is dealing with stressed assets worth 1.7 lakh crore rupees. The Parliament panel on energy has also said that Feb 12th circular should not be implemented mechanically on the power sector. My question really is that bankers believe that differentiated norms may open a Pandora's box. What is then going to be the way out? Because while there is stress on power, there is also stress on other sectors, and they may ask for this differentiation, this leeway as well.
No, this I think the High Court's direction is that the Secretary of Finance should look at, hear them, find whether any alternative way can be designed, and Secretary DFS is beating the power sector players into this and the Reserve Bank, and let us see whether some solution can emerge from this, some better idea can come. If a better idea can come, it might be worth trying in other sectors as well. So, it is an exploratory measure where you try to think of whether any better solution exists or not. It is in that process, and that should be again examined and discussed on by the participants, and if they can come up with a fairer, better solution, we should adopt that.
Mr. Garg, you alluded to we should keep an open mind as far as the bad bank idea is concerned and weigh every option. Is there a sense of urgency? Is there a sense of impatience with the pace of resolution at IBC? I mean, so far we've only got Bhushan Steel and Electro Steel that has gone to. The big ones like SR are still stuck. Is the delay, is the pace a little frustrating as far as resolution is concerned?
See, the system which we have in the country now is far more efficient and far more prompt than the system we had earlier, right. Earlier system had hardly any resolution. This system in a space of less than 1 year has resolved at least 2 big cases and many more smaller cases which the media does not take note of. It is a fact that in certain sectors the resolutions have not come about. It is taking longer because of the specific problems those sectors have. Going to the liquidation is the easiest solution, but that is not the best economically speaking. And when you in the IBC regime, if you are trying to find a resolution based solution, then possibly in certain sectors which are not specifically in the vibrant mode like the steel sector and all currently, it might take time. We should be patient about it.
Indeed. A very quick question before I wrap up things. Just two quick questions here, sir. Recently, the RBI governor deposed before the parliamentary panel and repeated what he had said in his recent speech, that under Section 51 of the Banking Regulation Act, the RBI does not have power to monitor the banks. The government, on the other hand, insists that RBI is the regulator, and as shareholders, you don't have much power over PSBs. What does this tell you about regulation, and is there a slugfest on regulation as far as public sector banks are concerned that are already saddled with bad debt? And given this dialogue that is coming in from both sides, is there a case for amending the Banking Regulation Act at all?
I won't comment on this. This is being examined and being discussed by DFS with the Reserve Bank. So I think he would be in a better position to answer on this.
Fair point. Two quick last questions, and one of them has to do with one of India's largest private sector lenders and a huge stakeholder in the Indian economy, the ICICI Bank issue. I know the law will take its own course. There's already a probe that's been ordered. It's a systematically important bank. SEBI.
You don't have questions concerning matters which I deal with.
Okay. So, sir, a quick last question to you, because you're heading a committee on the future of bitcoins in India. Tax department wants to ban it. There are voices within the government that believe that bitcoin could be a reality. Is it a solution, or is the panel in favor of tough riders? I mean, what is your personal call on this one?
Yeah, now on that we are fairly close to developing a kind of template which we think might be in the best interest of our country, and we have prepared a kind of draft which we intend to discuss with the committee members in the first week of July, and hope to then, so we actually moved quite a lot in that what part of this business should be banned, what should be preserved and what not. That kind of lot of detailed work has happened, and now we should be in a position to wrap this up in the first fortnight of July.
So before you go, we are celebrating our 9th anniversary here at ET Now, and I would like you to wish all our viewers and all of us a very happy anniversary here.
Thank you very much, and all the best to you. Great job. Thank you.
Thank you very much, sir, for joining us right here on ET Now. It was a pleasure chatting with Mr. Subhash Chandra Garg, India's Secretary for Department of Economic Affairs, talking on the state of the economy right here on the channel.